Bill, is it pretty much a foregone conclusion? Are we going to cut interest rates by 0.25% at the meeting tomorrow for the Fed?
Yes, yeah, I think that the markets are already, have that well priced in, and I think we can also be rest assured that President Trump won't be happy with only a quarter, but that's probably all he's going to get.
So is there a situation right now where we see oil prices possibly rising, maybe just short or medium term, inflation starting to pick up a little bit, where the Fed maybe shouldn't be cutting interest rates? Or is this a situation where the markets really need rate cuts to keep going towards record highs?
Yeah, and I think the Fed's going to call any sort of inflation pickup we might get transitory. I think they're going to focus more, if they even talk about it at all this time, about the danger perhaps to the global economy. Because the interesting thing is, at least in the U.S., and this is interesting because it's different than it used to be not that long ago, but because of the shale revolution, you actually probably see fourth quarter GDP in the U.S. a little bit better thanks to these higher oil prices, and probably see a little bit firmer industrial production because it kind of sets a floor under that for now. The problem comes more globally, where you see maybe more pressure on, say, Europe, and then also in some of the emerging markets. I'll pick out specifically like India, that doesn't adapt as well to higher oil. Most countries use less oil. They have a hard time changing over. So you probably still see, even though we see prices go up, you still see demand stay higher.
The rally in energy stocks, energy companies, has been pretty dramatic. I mean, albeit off, yes, very admittedly depressed levels. Is this something that can continue if oil doesn't have a move that much higher from where we are right now?
Yeah, it's a tough one. We've been talking about it at Avalon, because we have some decent exposure to the energy place, which until obviously recently has been a bit painful. They can, in the sense that maybe you've got some sort of risk premium now, probably rightly so, built into some of the companies, and the fact that you have some optionality in terms of the upside. I would say we're not in a place where we necessarily chase them at this point, but obviously happy with the ones that we own.
If you were in a situation where you needed to put new money to work, with markets 1% away from record highs, there are underperforming parts of the market. Are you still value hunting, or are you looking for places that have now been discounted in the growth phase? So the Alphabets of the world, right, the Facebooks of the world, the Amazons, that sort of thing.
I still think the value side of the equation, so the more cyclical side, is still cheaper relative. I still think there's enough of worries about, say, the global economy, the U.S. economy, et cetera. Obviously not to the extreme that we had, but I still think you think about the industrials, consumer discretionary, because there's still some worries that some of that may crack, and obviously some of that worries picked up again here with the oil. Though, like I said, I think people should keep in mind that it is different this time. In the past, we used to say, hey, it was unequivocal that the U.S. suffered under higher oil prices. Now it's actually, we do benefit up to a point.